So I just filmed this entire video that I'm about to do. And then I looked at it and I went, okay, I need to disclose this. So this is my dog Muppet. She does not talk, but she's gonna be sitting in my lap. So if you see some ears or a sweater, it's her, okay? She's been very needy recently and has decided she lives in my lap 24 hours a day. So yeah, that's something we'll talk about later. Okay, so we're gonna do a little home buyer 101 today. Yes. So this is the year where we talk about all the basics. And one of the things that I see a lot of is confusion over impound, also known as escrow accounts. Yes, this is one of those things that is really confusing, especially for first-time home buyers. And it is confusing, so I'm gonna try to make it super basic for you so that you understand. If you're buying a house right now and you're like, it doesn't make sense, I hope this helps. So here's the deal. There are certain loans that require an impound account. So anything with less than 20% down, conventional, a bunch of the government ones, you name it, there's a bunch of them that require impound accounts. So what is that? So what that means is that every single month, the lender is collecting principal, interest, taxes, and insurance, okay? Now, if you were putting down 20%, you would have the choice. Do you want taxes and insurance in your monthly payment, or do you want to pay them separately? Okay. Now, the reason the lower down payment options require that it's in the payment is that for any reason, if you don't make the payment on your property taxes, the county can put a lien on your house, and that goes in front of the mortgage lien. And we always want to be first. So that's why you'll see with lower down payment loans that this is a requirement. It's because we want to make sure those taxes get paid. So the best way to think about this is that you're making your monthly payment of taxes and insurance, and the lender is putting it in a piggy bank for you so that when the taxes are due, they can make the payment. Basic, right? Okay, here's where it always goes poorly. So let's say you're buying your first house, and let's say that you're closing, we're gonna go back in time because it makes my example easier. So let's say you closed on January 2nd, okay? Now, at closing, you're always paying 1 full year of homeowner's insurance up front. Now, the other thing is that your first payment, let's say it's in February, okay? I'm gonna use California as an example for this. California, the taxes are due in March and they're due in November. So March and November, here we go. So you close in January on your dream home. You're so excited. You make your first payment in February. That payment has principal and interest, 1 month of property taxes, and 1 month of insurance, okay? Property taxes are due March 1st. I don't have your payment yet. The property taxes in March are for 6 months. How do I, as the bank, pay it? I can't just be like, hey, dude, I need another 5 months. It's not the way it works. So what happens is at closing, so when you close that loan in January, we look at it, it's analyzed, and they go, okay, so the first payment will be in February. Therefore, in order to make the March tax payment, we need to collect 5 months of taxes, okay? It's all government regulated. And sometimes people go, well, I'm paying it monthly, why are you collecting it again? And it's like, no, we're not collecting it again. We literally, think about the piggy bank. So if you need $6 from the piggy bank and I only have $1 in it because you've only made one payment, I can't pay that $6 bill. Whereas if at closing I collect $5, we get your first payment, which has $1, then the following month I can make that $6 payment. And then the payment you make for that month goes back in the piggy jar and it keeps on growing, okay? Till the next tax payment's due. And then once again, the piggy bank gets shook and your taxes get paid. So that's kind of the easiest way I think to think about it. Now, the insurance is one where people get pretty upset as well. And I say upset because buying a house for the first time is very emotional. It's really expensive too. So often you're gonna be like, I don't have any more money. Why do you guys want this? And I get that. So here's why. So January 2nd, you pay for a whole year of homeowner's insurance. And you're like, why would I pay you any more until next year? It's a piggy bank again. So we start collecting the money in February. So by the following January, I'm only going to have 11 months, and banks pay the insurance in 1 year installments. So that's why at closing, you'll see that they're collecting a year in, say, a month or two, depending on how the payments fall. So it's important to know the lender's not making any money off of doing this. They literally, you have a piggy bank, and they are helping you collect the money so that these bills get paid, and the lender will ultimately pay them. Now, two important things to note. The first is, and I get this question a lot, is I thought that the lender was paying my taxes, but I got this tax bill. You're always going to get a tax bill even if you have an impound account. And the reason is that the county needs to keep you in the loop, but also you're going to want that for when you file your taxes. You're going to want to show your tax person, hey, this is how much I paid in property taxes this year, because depending on your financial situation, it may be a write-off. Okay, so keep those tax bills. The other thing that happens a lot is sometimes when you're comparing lenders, you may go, okay, Bob's payment is $6 less than Jennifer. And I'm like, yeah, not really, because actually my interest rate is lower because I'm sassy like that. But Bob is charging you way less for homeowners insurance than I am. Bob's charging you $8 a month for homeowners insurance, which is not realistic. So what you need to understand is the lender does not control how much your homeowner's insurance is. Any estimate you get from a lender, we're estimating. We don't pick the insurance, you do. And if a lender says, I pick the insurance, no, they don't, it's illegal, totally illegal. I can't say you have to use XYZ, it is illegal. You pick the homeowner's insurance. So yes, you should definitely shop that. The other thing is property taxes. You may go, well, wait, his property taxes are $20 less a month. No, I mean, yeah, sure, on that loan estimate they are, but it's an estimate, you know? And what I see a lot of is I'll see lenders who will purposely do unrealistic property tax amount to win the client, because the bottom line is the county sets your taxes. We don't set your taxes, the county does. So I'm always estimating to what I think it's going to be for you so that you understand your full monthly payment. Whereas some lenders, to just appear cheaper, they're like, oh, $1 million house in California? Yeah, your property taxes will be $500 a month. No, they won't. No, they won't. No, no, no. So it's important to know lenders do not control how much your property taxes are. They also do not control how much your homeowner's insurance is. So I hope this has been helpful. If you have any questions, thoughts, feelings, if you need a loan, check out the states I'm licensed in. It's always in the body of these videos, because for compliance, we got to be so careful. But I'd love to help you. And yeah, thanks for watching. Say goodbye, Muppet. She's very moved by all of this, I think.